begin today with Cathie Wood and her view on inflation/deflation. And then I'm going to cover a number of views, points of view on optimistic, pessimistic, and balanced. Different views of where the market is going from here. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 13, 2023. I'm going to begin with Cathie Wood and a clip from her. And she is, her view is, this is very different because you don't hear this from others. And the reason I'm playing it is because she just keeps saying the same message and it is uniquely different. She is saying that we are heading to deflation. So everyone's talking about inflation. She's talking about deflation of asset prices. And then from there, she says we're going to head into a period, maybe an era of technology innovation stocks, an innovation environment. And I think in this clip she says that there's probably $200 trillion. It's hard to even say that. 200 trillion of value that is going to be unleashed in the innovation space. But you would at least say trillions or maybe even tens of trillions. But it's an interesting pattern of deflation and then innovation. Completely different from what others are saying. So listen to this clip and then I've got something else to show you.
When history books are written, we'll look back at this period and we'll see the sharp rise in inflation, which was caused by massive supply chain, really supply shocks from COVID and the war in Ukraine. And you will see, so sharp increase, and it feels like it's so slowly coming down. But when you start looking at these charts in history, this decline will look very like it was very rapid, and we will descend into deflationary territory. Don Luswin wrote a piece, it was an editorial in the Wall Street Journal, I believe, about this. And I think the Fed is going to be blamed for sending us into a deflationary period. Already we're getting negative signs for guidance. Home Depot, its same-store sales down 3 to 5% for the year now they're expecting.
ARK Invest CEO Cathie Wood has had a huge start to the year with her flagship fund ARKK up 30% year to date thanks to the rise of AI and innovations made by her basket of exponential technology stocks. However, Cathie, ever the contrarian investor, believes that something bigger is going to fuel growth and adoption of her innovation-based platforms, specifically crypto and AI, and that thing is deflation. Whilst most economists and analysts are predicting high inflation to stick around for longer than most expect, Cathie is expecting deflation to come fast and hard. She argues that when we look back on this point in history, we will see a huge fall off from the high inflation numbers caused by the pandemic, moving quickly into deflation. This is because technology and innovation is innately deflationary as advancements in artificial intelligence and robotics begin to replace thousands upon thousands of humans' jobs. Goods and services can be produced at scale at much lower prices. These lower prices can then be passed on to consumers. But why is deflation bullish for exponential technologies like crypto or Cathie Wood's innovation platforms? Well, it's because if we see sharp falls in inflation numbers, this signals to the Federal Reserve and central banks that they can lower interest rates and increase money printing to stimulate economies. When this happens, assets further out on the risk curve, crypto and technology, tend to outperform all other assets. In her latest interview with Bloomberg, Cathie breaks down her deflation thesis and also speaks on what investment moves she is making with the one exponential opportunity she sees is bigger than Bitcoin: artificial intelligence.
So the next thing I'm going to play is a clip from CNBC. This is Scott Wapner, who is interviewing 4 panelists. And his attempt, what he's trying to do, is to say, where do you stand? Where do you think the market is going from here? You, and so forth. So what I'm doing is I'm going to play you 3 of them that are somewhat pessimistic about the market view going forward, at least in the short run. I'll say the next 6 months. And they don't really go out beyond that. But they're, they're cautious about what they say. But really, when he tries to pin them down, yes or no, do you think we're in a bear market or a bull market? 3 of them say basically a bear market. 1 of them is more optimistic and takes more of a bull market view. So my goal here is to give you different perspectives. So if you have an optimistic view of the market and you're looking for information to support that you don't think the market is going to correct, you think it is going to continue upward, you'll find some information that'll support that position. On the other hand, if you think it is going to correct before it goes back up, you will find information to support that position. So I'm trying to give you a balanced view to say, different views on it. And the reason I do this is because not a single one of them will tell you, I know that this is going to happen, or you can take this to the bank, because they don't know that. They're just giving you an opinion. So if you think, okay, they're just talking heads, that's correct. They are just talking heads. But they have information related to, earnings and the economy and, growth and where money is flowing. They have all these, supporting ideas. But the reality is the market does what it wants to do. So I'll begin with this. So there are 3 people I'm going to play, and I'll just kind of play them in succession here. So he goes into Joe Terranova, Stephanie Link, and Bill Baruch. And so listen to these, and then following this, I'm going to play a brief clip from the 4th panelist, Kevin Simpson. And he's more of the optimistic view. So take a listen to these.
On that note, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. The return of the bull market, at least technically, but is it really back? We'll debate that with the investment committee. The S&P 500 now 20% off the October lows. Joining me for the hour today, Joe Terranova, Stephanie Link, Bill Baruch, and Capital Wealth Planning's Kevin Simpson is with us for the hour today as well. Let's check the markets. We do have fresh highs of the year, at least we did earlier. But as you can see, as Carl was just saying, we did back off 4,300. We're going for the first close above that level since August. So we did exit the longest, Joe, technical bear market since 1948. So technically we say, okay, we're in a new bull market. But are we really?
Well, it's a milestone, and it's technically driven. So you asked why. I will not say it's fundamentally driven. And the bond market is not confirming it. So there's this divergence between what we're seeing reflected in the equity market and what we're seeing in the bond market. The bond market yields have backed up, Scott, and they've stayed there. Now, I understand Australia, Canada has raised interest rates, but think of where we were for a 2-year just in early May. We're basically 100 basis points higher. And if you look at a 10-year, you're up about 75 basis points. So we're void of significant growth, that's for sure. We're still in an earnings recession.
So are we still in so what you're telling me is you're not convinced we're actually in a bull market?
Well, I'm giving you the reasons why.
Yeah, I know. You're taking a long time to get to my answer,
You could only validate, you could only say
this
that
is a yes or no question.
No, but you have to understand why. You have to understand why it's just concentrated to the technicals. The fundamentals are not confirming it. So I'll say this to you. It's a nice milestone. That's it. Okay. That's all it is.
All right. So, Steph, the question over the last couple of days is, are the bulls in charge again, or do the bears still have control of this market? How would you answer that question?
Well, there's parts of the market that are in a bull market, right? Technology, comm services, discretionary. The SMH is up 45%. That's definitely bull market stuff, right? That's positive. The rest of the market is struggling, and that's what we've been talking about all year. That's been the biggest surprise at how narrow the market has been. But when you add up comm services and technology, it's 35% of the S&P 500, so it's material. It's gotten us to where we are in the market overall. But I think because the economy is actually doing a little bit better, I think eventually we are going to see a broadening out and the laggards will catch up, especially if we are as I keep saying, the ninth inning with the Fed. Inflation is coming down, and earnings have actually held in, not as bad as expected. So I think you are going to see a broadening. Does that lead us into a huge bull market? I don't know, because there is alternatives out there right now in the fixed income arena as well as internationally.
So, all right. So Kevin Simpson, it's great to have you here for the hour. You're a pretty active trader, so you bring good perspective, good tactical perspective too. How would you answer the question? Savita Subramanian, Bank of America today says, bye-bye bear. Being underinvested in stocks and cyclicals is still the key risk. What do you think?
Well, that's the risk to the upside. So as an equity manager, we're always in the market, Scott, but my feeling is we're not in a bull market just yet. You've got 5, 6, 8, maybe 9 stocks that have been leading it. But last Thursday was the first time we saw breadth actually take place and be a sustainable difference in the trade. So we're not talking about just those handful of names. And here we are a week into it, and we haven't seen a divergence away from it. So the best thing that could happen is that we're having this conversation a few months from now. We're all giving you a yes, and the rest of the market, everything but those 5, 6, 7, 8 stocks, are catching up.
But you need to wait a couple of months to see if that broadening of the rally is legit before you're ready to suggest that the bulls are in charge again for the first time in quite some time?
Yeah, absolutely. I think the Fed has to be done raising rates before we can be in a real sustainable moment.
But don't we anticipate when they are going to be done, by the time you get the official all clear, the market's already moved so significantly ahead of you, hasn't it?
Yeah, absolutely. You have to be in the market before that. But Canada said they were done. Australia said they were done. Not that we follow those markets that closely. We'll probably get a pause next week. We'll get into it, I'm sure, a little bit more in detail. But I'm not sure that the Fed here is done yet. And until they are, it's going to be tough for me to validate that we're in a bull market.
I mean, so
it's fun sitting here and talking about whether it's a bull market or a bear market still. But do you really want to be buying stocks and really loading into stocks when it's finally officially a bull market? And for us, it's looking back at March. At the end of March, we started seeing these divergences, and our theme was bring out your 2019 playbook, and tech is going to lead us out of this hole. So for us, in our positioning, in our mindset, it's been a bull market. What happened from last week was the Russell 2000 is up about 6.5% since then. You're getting the breadth, you're getting other parts of this market to start to join. And the Russell 2000 really broke out of that hole. And for us, that turns on the green light for some of the other portions of the market. We've begun rotating a bit. Still, though, I'm watching very closely. I trade the futures as well. The S&P futures, 4,300 to 4,330. We need to close above there on a weekly basis. We have not done that yet.
Next, I'm going to play a clip. This is really interesting to me because I had not heard of this guy. I didn't even know his name. Tillman Fertitta. Tillman Fertitta from Houston. And he is being interviewed by Brian Sullivan. What's interesting about Tillman is that he is the owner of Landry, which is they own a lot of sports and restaurant, hospitality, consumer-oriented brands, including the Houston Rockets and Golden Nugget in Las Vegas, and many chains of restaurants, and I think probably some hotels. Anyway, it's a fairly large, it's private, but it's a fairly large company, and he's the CEO, and he has the perspective. So think of this. Okay, he's got the Golden Nugget and, the various casinos related to that, and he's got the Houston Rockets and all of these restaurants and hotels. So his view of the consumer and where the consumer is spending discretionary dollars, there probably isn't a better person in America who has a view of what's going on with consumer spending. And I'd never heard of him, but he's a pretty big deal, but I think he stays fairly under the radar in private. But anyway, I just think it's a very interesting interview. And he says, basically his view is wait until second quarter earnings come out. They're not going to be that good. And then third quarter, we're going to see a contraction in consumer spending, and he tells why. Take a listen to this.
Your next guest is at the helm of restaurant giant Landry's. They own a ton of restaurants Del Frisco's, Morton's, Mastro's, the Chart House, and many, many more. Joining us now is Landry's owner, Tillman Fertitta. Also owns the Golden Nugget casino chain, the app, the Post Oak Hotel in Houston, by the way, one of the best, if not the best in America, Tillman, and the Houston Rockets, as well as the Montage in Laguna Beach. And that's all the time we have for the interview. I'm kidding. Tillman, it's good to have you back on the program. You and I have talked forever about this. Is there any sign of any type of inflation, whether it's beef or labor or booze or whatever, starting to moderate or even come down?
It is starting to come down just a little bit right now, but you just showed it. If you don't have herds, you're not going to get beef. And as we look into the future right now, the herd is shrinking, and therefore beef prices are not going to come down unless we go into such a pullback that people just aren't out ordering whatsoever.
You know, we just heard our return to office statistics, and I don't want to get into pandemic arguments because it generates all kinds of just debate on stuff that we're not trying to talk about. But you know, I've visited you in Houston many times, you know, in the last couple of years, and Texas maybe opened up earlier, and there were 2-hour waits at restaurants when things in New York were still closed. You've got your finger, you know, in Vegas and New York and Houston and Beverly Hills and whatever. Is everything kind of back in many places, or are you still starting, like we just showed in Manhattan on a Friday, it's still weak?
Well, it is weak on a Friday lunch and a Thursday lunch. But don't forget, everybody in the consumer business had the best years they ever had when 21 and 22 rolled around, because there was so much stimulus money out there. And so you weren't having the business meetings, but the consumer was going out on their own and spending money. And all that business is now pulled back. And it's going to get worse now when all these people have to start. You're taking millions of people that are in the workforce that are educated that now are going to have to start paying their student loans again. So you're going to continue to see a huge pullback as we go into the fall and companies continue to struggle. And second quarter numbers for consumer companies is not going to be good. And you can just bank that one.
So this is a clip from Jim Lacamp and Sara Eisen from CNBC, and he's talking about the various reasons why he believes there are headwinds ahead of us and that investors should be very, he uses the word careful. I will say cautious. Same thing. Going forward because of all of the issues. However, when we look at the last 6 months, we would say the market seems to just shrug this off, ignore it, and keeps on going higher. So what he's saying is kind of going against the wind, just like Tillman Fertitta said and others. And but I think he's right. I think the view here is, at least in the short term, there are some headwinds and concerns for caution should be applied here. If you are investing your own money or if someone else is investing, make sure that you have a cautious approach going forward.
Joining us now is Morgan Stanley Senior VP of Investments, Jim Lacamp. You getting pushback for this view from your clients?
Not really. Here's the thing. If you look at all the reasons to be skeptical of this market, senior loan officer surveys are showing tightening credit. Yield curve is still inverted. The Fed is still hiking. The economic slowdown is very visible here, not only here, but in China now and in the Eurozone. There's a lot of all the regional Fed surveys are weak. And so there's reasons to believe that this market is really running on thin air right now. But the thing is, what if investors are already positioned that way? What if you have already shaken out all of the sellers? Then you set the table for a short squeeze and a fear of missing out rally. And you have to be careful here. I think you have to be kind of a balanced mindset here because A, we're up against resistance to the 4,300 level on the S&P 500. B, seasonally, we're in that sell in May and go away time frame where we usually get a lot of volatility. And now C, we're 2 standard deviations away from the 50-day moving average, which is extreme overbought territory. That's usually when the market starts getting wobbly. So I'm not saying people shouldn't have exposure to the market. The market's moving. It's above the 200-day moving average. We have some themes we can play. We have some rotation now into the small caps, energy, and some other names. there are reasons to be a little bit optimistic, but I think investors have to be very, very careful here because all those concerns still exist.
You must have thought you're not going to avoid me playing something from Mike Wilson. So Mike Wilson from Morgan Stanley, I'm going to show you just a very brief clip from him. This is from last week. Everything I'm showing you is from last week. And this is his view. And so he is holding firm to his conviction, his belief that earnings are going to drive the market and that we are headed into a period, probably the second quarter earnings when they get reported, or third quarter earnings. At some point this year, we are headed into a period where the market will correct. I don't think it will crash. He doesn't imply that, but where it will correct. By that, I interpret this, it's just an opinion, I interpret this as the market will go down 10 to 20%. I don't know that, he doesn't say it, but when you look at how far earnings have got to come down based on their analysis, that would be my estimation. The reason I put a lot of stock in what Mike Wilson says is because he's the U.S. equity strategist for Morgan Stanley, and what they do, his team does, is that they call every one of these companies and they talk to the chief financial officer usually, and where do you see things going? Where are things right now? What is your view in the future? They take that data, they compile it, and build a composite model. So this is not based on, I think this, I think that. It's based on conversations with the companies, the major companies in the market, and a model that is developed around what they're saying. So he may be off a quarter here or there, but I think by the time we get to the end of the year, my opinion is I don't think he's going to be wrong. So this is his view. It's a audio podcast, so I'll play about a minute and a half for you, and I think you'll find this interesting, and you can put this together with the other views that I've just played.
Welcome to Thoughts on the Market. I'm Mike Wilson, Chief Investment Officer and Chief U.S. Equity Strategist for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the latest trends in the financial marketplace. It's Monday, June 5th at 11 a.m. in New York. So let's get after it. For the past several years, our overarching view on markets has been driven by our hotter but shorter cycle regime framework. More specifically, we wrote a report over 2 years ago that argued this cycle will run hotter but shorter than what we've experienced over the past 50 years. We based this thesis in part on our comparison to the post-World War II time period, which looks quite similar to today in many respects. First and foremost, the excess savings buildup during World War II and the COVID lockdowns were released into the economy at a time when supply was constrained. The punchline is that both the fundamentals and asset prices returned to prior cycle highs at a historically fast pace. This boom in inflation and earnings in 2021 then led to the Fed tightening policy at the fastest pace in 40 years, a policy reaction that proved to be surprising to many investors. Now we suspect many will be surprised again by the depth of the earnings decline in 2023, as well as the subsequent rebound in 2024 and 25.
And my final piece that I want to show you is from Roger Ferguson. He is the former vice chair of the Federal Reserve. So a lofty position, but the key word is former. So now that he's no longer with the Federal Reserve, he is free to say things that sometimes they don't say when they're members of the Fed. And his view of rate cuts or rate hikes, the consensus is we're going to pause right here and not have a rate hike this month, the month of June, and that may be a question if we're going to even have any more. And he's saying, no, not so fast. 50-50 chance we're going to have a rate hike or versus a pause. And that whichever one we do, there are more rate hikes likely to follow. So what that means is when you translate it in terms of maybe the economy or the stock market, we're at the point with, I think we've had 10 rate hikes. So with if there's more rate hikes ahead of us, this is going to further put headwind to the stock market and is probably not good for equities, at least in the short run. So take a listen to Roger Ferguson.
What is your outlook for this next meeting? You see a pause, a so-called hawkish pause, maybe even a rate hike?
So I'm not as convinced as the market that a pause is baked in. You just said that the market is pricing in an 80% expectation of a pause. I actually think it's a 50-50, very, very close call. But most importantly, the big picture is even if they do pause, as we've seen with other central banks, that does not mean that they're over. And so the market should, I think, brace itself for a Fed that is going to continue to be hiking, even if this one happens to be a pause. And I think the pause here is really a closer call than the market currently expects.
Okay, now we're going to shift gears into the flow of funds report. And this shows you, as of last week, where money was going. And so when you look at the macro picture, it tells a story when you put it together with all the other data. So conventional equity funds, an outflow, this has happened how many weeks in a row? A lot. Outflows, 17.4 billion out of conventional equity funds. What's interesting is, look at the equity markets. The equity markets are going up. They're going up on fumes because the big money is coming out of the market. Very interesting. Conventional bond funds had net outflows of 3.9 billion. No surprise there, because bonds have not been advancing hardly at all, maybe even slightly negative. So that's not a surprise. Money market funds, no surprise here, had an inflow of 36 billion. Again, flight to safety. But that's interesting in light of my comment that equity funds are going up. It looks like money's coming into the market. It's positive, and yet money is coming out of equity funds and going into money market. Not 100%, but the more on a net basis, the net is outflows of equity and inflows of money market. I've talked about this before, and I don't have anything official to show on this, because I read a lot of blogs and information, but they seem very unofficial, sometimes not validated or confirmed. But I do read a lot about this, and that is where there is a food shortage to some degree now, but in the coming months and maybe even the coming year or more, there is going to be more of a food shortage. And I'm saying this more as a cautionary tone to you, that if you have the opportunity based on where you live, if you have the opportunity, think of the option of growing some vegetables on your own. Fruit is different because sometimes fruit comes in trees and things like that. But if you have the opportunity to grow vegetables, be able to provide food for yourself if we get to a point where there is a food shortage. If you don't, there's another option. It's a very good option. And that is, there are farmers in every area that community food share arrangements where you can go and buy food, organic food from organically produced from farmers in your area. In every area of the country, there are farmers. And you know how you find them? The farmers market. You have a farmers market in your area. If you're interested in this, I'm not telling you what to do. So if this is of interest and you're looking for a plan B, if it's hard to get food, you can go to the farmers market, look at what people are selling, build a relationship, and start buying from the people that you like, so that if we get to the point where you need to buy, you need to have an alternative source, you will have a relationship, you will know where to go, and etc. So, as they say, just maybe a word to the wise. So thank you for watching, and if you have questions or comments, leave them in the comment section below. Thank you.